This is the Retirement Planning University podcast with Jordan Schwartz and Phyllis Polvinas.
Welcome back to the Retirement Planning University podcast. I'm your host, Jordan Schwartz.
Hey, Josh, I got a question for you, though.
Sure, yeah.
You've been doing retirement planning for a long time, and I know you have 2 children, right?
I have 3.
Three, that's right. I forgot
twins,
that.
9-year-old twins, and a little guy's 5.
That's right. I forgot you had twins. God bless you. All I know is every 5 minutes you're going to Disney. How do you teach them about retirement planning when they get to go to Disney and spend all that money?
Well, some of that's due to their mother, not from their dad. But, what is it? You got to work like nobody else so you can live like nobody else or something like that. And quite candidly, too, my wife and I, we live very practically, on the week-to-week, month-to-month basis so that we're able to do those things that we truly value. So rather than buy our kids a bunch of stuff and junk and iPads and big TVs and things like that, we like to give them experiences, and Disney, unfortunately, is part of that. But yeah. So
I'm just teasing you, by the way, because I've been in retirement planning for lots of years. When my kids were little, that's where we went a lot.
Yeah, my wife's always like, well, it's one more year, with the little guy. It's one more year. But they do turn 10. You may not know this, but Disney charging you more when your kids are 10. So we may have to cut back a little bit. They charge the full adult price when they turn age 10. So the twins will be 10 next year. So we may be dialing that back, Phyllis, and going more on additional beach vacations and the like.
You could put them to work to pay for it. You could do that as well. But
yeah, exactly.
Josh, I know we're going to talk about tax planning today, but you said something that I wanted to ask you about real quick that was interesting. You and I have talked about this before, and something that I've always really admired about you and appreciated about you is that you live so much less than your means. How did you kind of establish some of those habits with you and Emily early on, where for someone who's listening and building for retirement, or maybe a client who's trying to get back on track or prepare for retirement, what are some things that you've done that have really helped you prepare for that?
I think where everybody comes from, at least for me, it came from watching my parents. I grew up with teenage parents, and I love my mom and dad. They're still 2 of my best friends, but money was always a constant point of stress and struggle in our household growing up. We always had a roof on our head. We always had food in our bellies, but there were many weeks where we were living on the razor edge thin. And back when I was growing up with the kid, there's a Jim Rome saying that I like a lot. He says, used to be when you're growing up as a kid, you had until you had $0 in your bank account, and then you were broke. He said, but now they give you credit cards and you can fly by that $0 and go all the way negative. But growing up as a kid, my parents didn't have credit cards and things like that. So, we always wanted to make sure that the income coming in was always greater than the expenses going out. Mm-hmm. And one of the things, and you can ask my wife, Emily, that I still do this religiously. Jordan may get on me a little bit later about this, but literally I spend about 30 minutes on the weekend, and I balance our checkbook. Now I have computer software that allows me to do it. I still do that every week. And, if you just think about it is, if you can't, and again, let's be candid here, guys. We're helping couples manage their lifetime of assets. They're working with a financial advisor who can't manage their own assets in their own home. How comfortable would you be allowing them to manage yours? That seems kind of crazy, right? So, yeah. That's
how I've always felt, is if I can't be the example or the model for which I'm recommending to my clients, I'm not worthy of helping them with that. And I do the same thing too on the weekends. I always go through and I look at every single transaction that was made, what we spent it on, what the day was. And I've always done that. And that is just, for me, an accountability tool to make sure we're staying within our budget and we're staying within our numbers so we save properly for retirement. That's cool.
I do the same thing. I think I do it more than once a week, though. I forget. No. Yeah, I do it a couple times. Just double check.
Yeah. Josh, I got an interesting question for you. At Strategic Wealth, you do a lot of tax conversion planning with clients, Roth conversions, insurance. But one thing I'm curious to get your opinion on is how much of someone's IRA is actually their IRA? How much is theirs?
It depends. And I know why he says that, because he's heard me say it before. You look at the word theirs, when you have your IRA, your 401k, any type of qualified retirement plan, a thrift savings plan, if you're a government employee, some of it's yours, but some of it is theirs, like Jordan mentioned. And notice theirs is spelled with the N, the IRS at the end. And if you ever, any of our clients, if you're a current client listening to this or a prospective, if you've ever pulled out money out of a retirement account, the first thing you got to pay is actually, you don't get to pay yourself first. You have to pay the Internal Revenue Service first. Okay. It's just like when you're working, your employer may be paying you, let's say they're paying you $120,000 a year as your salary. It's not as if at the end of that month, if you got paid monthly, you get a check for 10 grand, right? You got to pay all those taxes, the federal, the state, the local, FICA, Medicare, you name it, right? You got to pay all those taxes first before you get that. The same thing applies with your IRAs or your 401ks. All those dollars have to come out at the federal, state, and the local level before you get a dollar yourself. And it also depends on what the rates are at that time. And that's the key. And I think that's maybe some of the things we're going to be talking about here a little bit later here, Jordan, is what do we believe the rates are going to be at the time when we actually need that?
Well, I know I always come to you whenever I need someone to paint the picture for me for what do things look like in the future. And something Jeff Bezos said that I always thought was interesting. He said, don't think about things in terms of, what's not going to be there in the future. Think about what's actually going to be there in the future. And what I remember too, a few years ago, we were in Las Vegas. I remember you and Emily, you went to the debt clock and you took a photo with the debt clock. Now, do you know off the top of your head how much debt there was when you took the photo at the time versus now?
I think when I went to the debt clock, and guys, this is February of 2020. So let me paint a picture for you. Oh. I'm in Las Vegas, February 2020, and I go to take a picture in front of the debt clock because I'm strange like that. And I always knew that the number was going to be higher in the future, but I had no clue. But then, Phyllis, I'm just curious, did something happen the next month in March of 2020? I feel like something kind of strange kind of happened.
Yeah.
Did the government tell us to stop seeing our family? Did they shut down a bunch of businesses?
A lot of arms got sore after that. Yeah.
Yeah.
Stay at home for a long time.
Yeah, stay at home. And again, it's okay if you didn't need to go to work, right? Because the government was going to pay you to stay at home. It was very strange.
Very strange, the case.
Yeah, and I think that number back in February 2020, Jordan, I think I may be wrong on this. I wish I'd have known you were going to ask me that. I had that picture up before. It was either 22 or 23 trillion dollars at that time.
Okay, so guess right now. I just pulled this up when we were talking. Guess what the number is right now?
Oh, I have it up here too. It's about 10 trillion more. It's about 33. Oh gosh, coming up on 34 trillion pretty quickly. I mean, this thing is getting really, really out of hand very quickly. And I just saw a recent statistic that for the first time in our history, just the interest on the national debt is scheduled to exceed not only military spending, but also is scheduled to exceed about $1 trillion in income taxes. And so just to give you an idea right now, in total tax revenue that the government actually collects today, it's estimated to be, as of today, about $4.4 trillion a year. So nearly a quarter of that. Think about that. Thinking you're making $100,000 a year. Put it in your own household perspective. You're making $100,000 per year, and nearly a quarter of that, or about $25,000 of it, is going just to interest to your credit card. Let's just say it's a credit card company, and let's say you talk to your, whoever you love, your brother, your sister, your brother-in-law, your mom, your dad. What do you think they're going to tell you that all this credit card debt that you have going out there? What do you think they're going to tell you about your debt problem? Are they going to say, hey, everything's okay, Jordan? You and Gene keep on having at it. Good job. Yeah. And just to give you an idea, that's what the government's collecting. Okay. So think of all that this year. And I got it up here. They're going to collect about $4.4 trillion. But see, the problem is not the tax collection. They're taxing us more than they ever have. They're actually going to spend about $6.1 trillion this year.
Now I'm depressed. Very depressed.
Yeah.
It's ridiculous.
So just to think about that, they're going to spend about $1.5 trillion. And by the way, if you really want to have fun with your kids, like I do, my 9-year-old's probably the only kids in their school that know how to write down $1 trillion. Okay. They're the only fourth graders that know what $1 trillion is. Okay. But I mean, just think about that in your own household. Let's just say you're making $88,000 a year in income. Okay. But you're spending $122,000. I mean, that's kind of what's going on here. And yeah, you can get by with it a year or two on credit cards, but eventually, I mean, you and I, we can't live like that, but somehow our government has been able to. So that just leads you probably, and I would ask the audience, where do you think taxes have to go to right this ship?
Well, Josh, one question comes to mind is what can the government do? Because there's two options, right? There's either we can cut spending or we can raise taxes. And does our government show a pattern consistently over time of ever cutting any spending?
Mm-hmm. That's a joke.
It's a joke, right? And I think either side, whoever you see in the White House, they'll continue to raise spending. That really only leads the next inevitability of, don't you think taxes have to go up?
I mean, absolutely. And again, it's not necessarily tax rates that have to increase. It's just total taxes.
Well, you speak to that. What do you mean by that?
So what I mean by that is I think a lot of times people think, one of the things I would have everybody in the audience do is just look at, and I was hoping to get this statistic up here. I don't have it up here, but actually look up what 50% of the country makes in income.
Pull this up right now while you're talking.
And Jordan, let me know if you're able to find it. I was trying to find it before I got here, but because a lot of people think, well, I'm not susceptible to that, Josh. Most of our clients are good, middle-class, hardworking people. And if a lot of your assets are in let's say a tax-deferred account, and if you've been working hard, doing what you're supposed to be doing, I mean, you're probably used to a certain lifestyle income, and again, and for everybody, it's different, right? I mean, everybody needs different amount, but maybe as a household, maybe you're making $80,000, $100,000, $150,000. You may not think that higher taxes are going to affect you, but they absolutely are going to affect you.
The U.S. population makes over 75. The other half makes less than 75. It's about 50-50.
Yeah. So I just want you to think about it. That's household, I believe, Jordan. Mm-hmm. And so just think about that. If you make more than $75,000 a year, you make more than half of the country as a household. So a husband and wife, if they're both working, most likely easily make over that. So you're living better than over half the country is. And there's a lot of people who think, well, the rich just have to pay more. Well, newsflash, the rich have lawyers and accountants. They can afford to pay all these specialists, even folks like us, they pay us, right? They can help them with different tax strategies to help minimize kind of those tax burden going on. And I just think you got to look back historically of where tax rates are. And, I think and again, Jordan, obviously, me, I'm not a betting man, right? I don't like to gamble. But if I were a betting man, I think there's two ways that they're going to dramatically increase revenue. There's an old 60 Minutes commercial or interview they did with the senator. I forget the senator name. It doesn't matter. It was about the deficit during, I think, like the 1990s. Okay. Back then, they were still debating this back then. And he said, well, when are you going to shoot right with the public and tell them that we need to raise taxes? He goes, well, no, I don't think we need to do that, but we do need to raise revenues. Isn't that the same thing? Right. Because that's the government's problem. They need to raise revenue. So to me, there's a couple of ways, and you can already see this in the tax code that they're doing this. They already means test your Medicare. It's what's called IRMA, income-related Medicare adjustments. Okay. Phyllis, I know you met with a lot of your clients. I know you talked to them a lot about IRMA. You know what I'm talking about,
Absolutely.
Right? She's not a mean old lady. She's not a real person. It's just an acronym. Okay. But I think that's one way they're going to do that. And one way they determine how much your Medicare premium is, it's based upon your AGI, which guess what? Every dollar you pull out of those retirement accounts, Jordan, does that add on to your AGI?
Yeah.
It's a tax deferred account? Absolutely. So who's to say that they wouldn't adjust that further down the line? Who's to say maybe they wouldn't do the same thing with Social Security as well? And then another thing that they could do, they could, if you look at our tax brackets right now, and I'm sorry, guys, I'm a nerd because I do this all the time. It's like 10% is the lowest tax bracket today, then 12, then 22, then 24, so on and so forth. I'd have to look at the numbers here, but it's something like if you made $360,000, so that's after your standard deduction, that's nearly $400,000 today. Your effective tax bracket is only about 18.9%. It's just under 19%. And what the effective is, if you take all those tax rates and you average them out, that's your effective rate. It's probably one of the lowest effective tax rates at such a high income we've ever had in this country. And so one of the ways that they might be able to collect more revenue, if you will, instead of keeping that 10%, that lowest bracket, well, what if they made that 15? Now, a lot of people look at that as, well, Josh, that's only a 5% increase. No, it's not. It's 50% more. And by the way, are there more people paying 10% and 12 in the 10 and 12% brackets than there are in those 32 and the higher brackets that are there? Jordan, you just said so yourself.
The highest bracket is between 50 to 74 a year at 16%. And most of them are kind of around the mean between 50 to 150 a year. But I think with what you're saying is it's really naive to not think taxes are going to be higher in the future, right? We've got all these things that we have to pay for. We've got all these unfunded liabilities. We've got probably, like you'd said, some means testing on Social Security in the future. I know we've even talked before about them creating maybe like a new Roth IRA tax or something like that. But I mean, do you think it's naive to think that taxes won't be higher in the future? It's
not that it's naive is to think that you won't be susceptible to them because you don't believe you're rich. I hate to say it like this, and this may come off as arrogant. If you're only making $75,000, if you're right there in the middle, I mean, are those people rich or are they just getting by? I mean, with gas nearly $3-4 a gallon, whatever it is, wherever you live. I mean, those people are barely getting by. But again, the government needs to raise revenue and they're going to need it from everybody.
Yeah, how about this? One thing that Congress is great at is doing nothing. And we know this. When the tax rate sunset in 2026, right there, everybody's getting a raise back to where it was before they went up, back to where they were in 2017. Just right there, it's going to cost people more. And that's a fact people have to wake up to.
Wasn't it 1914, whenever the federal government came out and said, we're charging federal tax rates? I think back then, I don't know what the percent.
Yeah, it's around 1912, 1913. 1913. 7%. Yeah.
7%. And the thought back then was, okay, we're only taxing the wealthy, right? And what happens oftentimes, to your point, Josh, you see IRMA and then it's Social Security. A lot of this legislation can become a slippery slope, and that the government says, oh, well, even some of the recent legislation, we're only taxing money on the wealthy. Well, to your point, if half the population is above 75 and half the population is below 75, it's not just going to be the wealthy. It's going to be the wealthy, then it's going to be everybody. Every time there is an opportunity for the government to charge more taxes, they will, because to your point, Josh, it sounds like they have to, otherwise there's not increased revenue.
Exactly. And again, if you're a nerd like me, you can go to taxfoundation.org, not a website or anything we're affiliated with, obviously, but that's a nonprofit. You can go and see what actual income tax brackets used to be. And here's a fun one, guys. This is just for me. So I mentioned if you can make up to $400,000 today, okay? It's roughly, don't hold me exactly to these numbers, right? But if you get your standard deduction, okay, you're going to max out the 24% bracket if you're a married couple filing jointly. Now, I think we all would agree $400,000, that's a pretty good income, for most American households. Most people would be happy for that household income, right? They might even be considered rich in some circles, right? Making $400,000 a year, right? Those individuals right now, their effective tax rate. So if you add in all the federal from the lowest tax bracket to that top 24%, their top tax bracket's only 24%. Their effective tax rate is under 19%. Okay. So just think about that just for a minute. They're paying less than 20% federal taxes. And yet, most people would consider those folks really rich, right? Now, people making $400,000, they never considered themselves rich. Okay. But I want you to think about this. The last president really known to cut taxes per se was Ronald Reagan, right? We all know about Ronald Reagan. So if you just go back a few years, okay, back in 1988, there was only two tax brackets, which I love the simplicity of it. Two tax brackets in 1988. The lowest tax bracket, Jordan, I'm gonna quiz you because I don't know why. I feel like Phyllis might know this answer. What was the lowest tax bracket somebody paid in 1988? Today it's 10%. What's the lowest then?
I think this might be a trick question, but lowering tax rates. I mean, if the lowest is 10% now, Phyllis, you're smiling. Do you know?
No, I actually
Do you
don't.
know?
I don't.
5%? Is it zero?
I think it was higher.
Yeah, it was 15.
Oh, wow.
Yeah.
Now, there was only one tax bracket ahead of that. Okay. Now, granted, this was probably a lot more money than it is today, but that next tax bracket was 28%. But do you know how much money you had to make to hit that 28% tax bracket? It was about $32,000 as a married couple. Granted, $32,000 back in 1988 probably seemed like a lot more, but was it $400,000 more? So think about where we're at today comparatively to where they were.
Where do you see it going? Where do you see the numbers trending towards in the future? What do you think's probable? Obviously, I know your crystal ball's in the shop right now, but
yeah, it's broken.
Listening to this, what does it look like 10 years from now, 15 years from now, in terms of what the taxes look like, and in terms of what someone's keeping in their pocket versus what the government's collecting?
I mean, I don't even want to think what they're going to be. I mean, we know what they're going to be in 2026 if Congress does not think they're going to revert back to where they were in 2017. If you want to look that up. I mean, I just think the question, our listeners need to ask themselves is, how much of this money do I want tax-free, and how much do I want it in the future susceptible to whatever the federal government deems I owe them? And again, the one thing I may disagree with you just a little bit, Jordan, here, is I do feel like they're going to try to cut spending. I think they're going to have to do both to make ends meet. But I want you to think not only about your federal income tax, but what's going to happen to state income taxes when the federal government starts cutting a lot of these programs. And by the way, do they like it when you cut government programs, or they want to riot and cause protest? Okay, so if these states are going to keep a lot of this, aren't they going to have to raise revenue too? So what's going to happen to your state income taxes?
So is it fair to say that we know that taxes are going to go up, but not just for the wealthy, whether we like it or not? It's going to go up for everybody. So your average person today who's retiring with most of their money, because they follow conventional wisdom, in pre-tax IRAs, 401ks, have a future problem whether they want to realize it or not. So we want to bring that to the forefront. They've got a problem. Any suggestions, Mr. Tax Whiz? How do we suggest they fix it? What do we want to tell them?
I mean, some of this, it's got to be surgical, right? I think if you're still working in your working years, if you have an option for a Roth option inside of your 401k, or obviously contribute to that after tax dollars, if you can do Roth conversions, you might want to take a look at that if it makes sense for you. But I would look outside of the box too, because you got to remember what is the problem? Onerous taxation. Why does the government have IRAs and 401ks? Why would they provide a solution like the Roth to the problem that they caused? Doesn't that make you a little bit suspicious?
Say that again, because I want to make sure everyone hears that, because that's an interesting distinction.
Well, because the problem that we're talking about here is onerous taxation. Just think about these qualified plans. And again, when I say the word qualified, remember, it's government qualified plans. The government
401k, 403b,
401k, IRAs,
457b, all that stuff.
Yeah, you got it. And I just want you to think about this. And I stole this from somebody else. It's not me, but I really like it a lot. I got it from one of my mentors. He said, Josh, why would the government create a solution that they're the cause of the problem? That's why, you want to consider things that are outside of the box. And again, everybody's different, but that may be, if you're a high net worth individual, doing some special trust planning, maybe some charitable planning. Maybe it's some permanent life insurance planning. Maybe it's looking to defer taxable assets in a normal brokerage or taxable account. There's a lot of different solutions that you need to be aware of, that you need to work with someone like ourselves or any fiduciary advisor that you have. And by the way, if your advisor's not talking about tax strategies, and again, I'm going to go out on a limb here, and of course I'm going to say this, right, because of my role here, but you need to fire them. What does it matter if you get 1 or 2% higher rate of return if your taxes double in the future? Now, I'm not going to say that they're going to double, but if they go up slightly, if that advisor's not talking to you about tax strategies, tax planning, or what they're going to help you with down the road, I mean, I can give you my suspicion why they don't want to talk to you about it. It creates complexity. They make money on assets under management. So, the more assets you put after tax, that's less dollars they're collecting revenue on. So, I mean, there's some reasons why, but I don't know in this landscape how you could be a good advisor and not at least having the conversation with the client about the potential impact taxes can have into the future. I mean, for most clients that are out there, when you get in retirement, you will pay more money to the Internal Revenue Service than you will anybody else. They're going to be your biggest creditor. Mm-hmm. Do you like being in debt? Nobody likes being in debt.
So what you're saying, Josh, is basically taxes in essence are on sale right now. With the state of the country, with how many things that we have to buy, we've been told all along, put money in your 401k IRA type plans where it's tax deferred. But the challenge in the future is if we think taxes are rising, now someone is going to have to pay taxes in the future higher than what they thought, because to your point, the government's providing a solution to a problem that they've created that doesn't seem like a good deal.
Yeah, and then ultimately, what do you want to have happen to the money? You really there's two clients. One of the classes I teach, I love saying this. Generally people that I meet with fall into two categories. Number one, their goal in life when they get in retirement, they spend every last dollar they save, and they leave $35 in an envelope for their kids to cover that bank overdraft fee for that last check. Right? They don't want to be a burden on anybody, but they want to spend and enjoy that money, right? Or you have clients that maybe they want to leave money. Maybe they want to leave a legacy. Maybe they want to leave money to their kids, or maybe to their grandkids, or maybe they want to leave it money to their charity. Well, you want to have a tax strategy around that, because the biggest expense on leaving money to your kids or leaving money to a charity is just going to be the tax implications of that. And if anybody want to have fun, or if you guys want to talk about more about this too, if we have time, I mean, you got to look up the Secure Act. They're going after the money. They're going after the money in these retirement accounts. And you need to look no further than something that was passed. I think it was, Phyllis, was it December 2019, I think?
Yes, right before COVID. Yeah.
Yeah, just before COVID. They passed it between Christmas and New Year's, I believe. Now, why would Congress pass a bill between Christmas and New Year's? Why do they want to work that hard during that holiday time period? What do you think they were trying to hide?
So why don't you tell the listener what that did? I mean, how that decimated the stretch and what that means for the inheritance.
So yeah, I mean, I'll just tell you, right now, let's say, Jordan, your parents are living, right?
Yes. Mm-hmm.
Yeah. And about how old are they right now? You don't have to give the exact age. Just
my mom would be very upset if I said what her age is. So my mom is only 35.
Okay.
My parents are, I'll say this.
It's a friend of yours. It's not your
They're
parents.
both collecting Social Security. I'll leave it at that.
Okay, we'll leave it at that. So let's just say they're age 70, right? And Jordan's parents do really well. They're going to leave them $10 million, right? Just kidding.
That'd be nice. That's not the case.
Yeah. So what it used to be, and what it used to be, mom and dad wanted to leave Junior $1 million. It's in an IRA, a 401k, some type of government qualified plan. Prior to 2019, when the son got the money, okay, and I'm going to give you a real life story right now of a real client that I work with, but I'll change some names and numbers and things just to, protect the innocent. They had the son had a lifetime to withdraw that money. Okay, they had what's called required minimum distribution, but basically the son on that $1 million would have to pull out, I don't know, 3 or 4% a year at that account. That would add on 30, 40 grand to their income. And again, yes, that adds on to their taxable income, but 30, 40 grand a year it's not significant. Now, I'm going to tell you a real life client that I have today, and I'm going to tell you what the new rules are. So a real life client I have, mom and dad were postal workers, got nice pensions and Social Security, made about 70, 80 grand a year. And they were happy. They lived well within their means. It was always more than enough. They left their only son $1 million in an IRA. There's worse things to leave. Okay. Now they raised their son right. He was an engineer. His wife's a school teacher. Their combined income, I think it was around $250,000 a year. Now the Secure Act says, now this guy's smart. By the way, most kids, they're not this smart. Most kids are going to do one of two things. They're going to take the money. They're going to blow it all in 1 year. Right. And then what's that going to do to their tax rate? Out the wazoo, right? Or they say, well, I don't need the money now. I want to defer it. Well, they shouldn't defer it either, because this is a problem. The kids now only have 10 years to spend 100% of that money. So my client who makes $250,000, now for him, we're withdrawing about 120 grand a year, I think is the number, because of some potential growth and things on that $1 million. Mm-hmm. So I want you to just think about it more. Who's collecting a lot more money in this scenario? So who would have been better off taking the money out? Mom and dad making 80 grand a year, or the son taking that money out and paying taxes on 370 grand a year?
What you're saying too, just so I can follow, is because of the new legislation that was passed in the Secure Act, now someone has to take all of that money out of that IRA over a 10-year period of time. Or in the past, they could just assume their parents' RMD, take 3 to 5% per year. In this $1 million example, 30 to 40, 50 grand a year. It's not going to destroy their taxes. But now they have to take that out over a 10-year period of time, probably at an age where they're in the highest income earning potential of their entire life, which means they're probably going to be bumped into a higher bracket.
Paying a lot higher tax rates, paying a lot more in taxes, and getting a lot less net. Again, right? And the thing to remember, all these qualified funds, the IRAs, the 401ks, they are accounts, meaning that the government, just like they did in 2019, it's the rule is 10 years now. Does that mean that they can't change that rule again?
Has the government ever said they're not going to do something and then turned around and did the opposite of what they said?
They never lied to us, Jordan. Never, ever, ever. But yeah, one of the Build Back Better proposals, it was just a proposal, didn't pass. Okay. So, but they were actually going to change that rule from 10 years to 5.
Wow.
Yep.
That was real. Okay. So that's why, Jordan, I like the Roth IRA and things like that, but it's an account. The government can change the rules on it. And so, that's why I like things like permanent life insurance. I know it's not popular, but it's a contract. A contract, typically you're grandfathered in. With an account, it could change the rules at any time. So just some food for thought there, because one of the things that we see, they're getting lobbied a lot by Wall Street to change increase the required minimum distribution age higher and higher and higher. And we've all seen that. I mean, personally, I like that they changed the RMD age from 70 and a half to like 72 or 7. Like they made it a whole number. I think that makes all of our lives a lot easier, right? I don't think 70 and a half was ever good. But why are they doing that? That doesn't make sense. Well, my personal belief is that they're hoping that mom and dad don't spend the money and there's a huge lump sum that's going to be left to somebody else. They're going to be forced to take that money out. When you take that money out, it's going to be like yelling fire in a theater. It's just going to go through there and they're going to just get whammied with taxes.
So for someone listening, you got to get busy with your retirement account. You got to understand what it's going to cost you over your lifetime. You're married, what it will do to your spouse. If you predecease that person, you're leaving them a tax bomb, and ultimately the kids. So get busy now while taxes are on sale, and have a strategy, whether it be Roth conversions, whether it be life insurance. And don't poo-poo that unless you understand the pros and cons and strings attached of life insurance. I know the talking heads always put it down and yada, 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 but take a look at it for you and your family. I think that's a big takeaway from what you just have been saying.
Yeah. Well, and Phyllis, you actually made an excellent point. I forgot to mention that's probably more likely than leaving the money to the kids. It's one spouse predeceases the other.
Yep.
I just unfortunately lost one of my favorite clients. Gentleman was in his late 60s. Great guy. I mean, just light up a room when he came in. But now your spouse is in a single tax bracket the rest of their retirement. And typically, the income, even if the income's the same, that spouse most likely is going to pay 50, 60, 70% more in taxes at that same income level than they would have as a married couple filing jointly.
Everybody ignores that. Just about everybody.
Yeah.
Ignores that. That's huge. Yeah. And that's our job to bring that up and bring that out.
So tax conversions make sense for kind of 3 big reasons. Number one, paying taxes now while they're arguably at a discount for what they're going to be in the future. That's one benefit. You put more in your pocket. Another benefit would be do it so if a spouse predeceases another one, we do it now so that the spouse has a lower taxable impact in the future. And then the third is if you want to leave a legacy for your loved ones, and that's a purpose of yours, do the conversions now, look at doing conversions so more goes to them in the future versus with some of the stretch law provisions they have with potential higher taxes in the future, it passes to them more intelligently. Am I summarizing that well?
Yeah, and I think the other thing is too, we're always aware of diversification. The idea, you don't want to have all your eggs in one basket. You don't want to have all your eggs in the Roth IRA basket. You don't want all your eggs in the permanent life insurance basket. You don't want all your eggs in your 401k or your IRA, right? We want to have enough, a couple of different strategies, a couple of different streams. You don't want to rely it all on just one strategy because things could change, things happen. Along the way, especially on the government qualified plans as well. I wouldn't just rely on the Roth IRA. I would look at charitable giving. I would look at permanent life insurance. I would look at different estate planning techniques. There's a lot of things you can do out there.
Josh, I love that. What I'm hearing is we diversify our investment strategy, right? You don't just want stocks and bonds. You typically want precious metals, real estate, commodities, treasuries, annuities for some private equity, all those non-correlated assets that are moving in different directions. But what you're also saying too is let's take a slice of the pie from that and apply it towards our tax conversion strategy. Because a Roth is an account using charitable strategies, insurance strategies, Roths, a lot of different things. That's how we can diversify that strategy too. So whatever does come in the future, we're prepared as well for it as possible.
Exactly. So get prepared in the event of a long-term care event. What's your strategy? If a spouse passes away, to Phyllis's point, what's the strategy if that surviving spouse is in a single tax bracket? What's the strategy there? What if this money grows so much? For some of our clients, been very blessed. The estate tax exclusion, that's something we haven't talked about, any of us, probably for 5 or 6 years. And yet I'm seeing more and more clients that unless they change the rules, we're going to have to think about estate taxes here soon. That exclusion drops dramatically. And again, you want a good way for the government to raise a lot of revenue and not make a lot of people upset. You just say, hey, I'm just going to tax these millionaires who have all this money. They've got plenty of money. Let's bring back the estate tax, baby. I mean, and again, I just hate to say it, but I mean, how many people are you really going to offend if you do that? A handful, right? But not that many people. So, and everybody's different in their own situation. But I mean, those are things that we gotta think about.
Have you all ever climbed a 14er? Have you done one of those before? So
yes,
when I lived in Colorado for about 3.5 years, there was, I think, 56 mountains that you could climb that were safe to climb, that had an elevation of over 14,000 feet above sea level, where it's weird when you're climbing, you eventually see where the tree line stops because it's not enough oxygen up there to do it. My wife and I did one time, and it was terribly.
Jordan, this sounds like a terrible idea for a boy from the Midwest. I'm just going to tell you.
Yeah, from someone who's what they call
trees won't grow there, Josh. This is an excellent idea for you to do with your wife.
Well, you got to get acclimated. For someone who's a flatlander by nature from Louisville, Kentucky, that's what all the Colorado people call us who live closer to sea level. It kind of had me thinking about like someone who would climb Mount Everest. Now, obviously, climbing a mountain of 14,000 feet, it's very different from that. But climbing up the mountain required a different mindset, a different set of thinking, taking breaks at different points, what to watch for, what to focus on. And what I found was when I was going down the mountain, my focus had to shift and the job wasn't finished. I got to the top, but the job wasn't finished. And it sounds like what you're saying is, climbing the mountain, I would argue climbing the mountain was actually easier going up than it was going down. And I think the same goes for retirement planning, where it's a lot easier to get to the top of the mountain, call that the point of retirement. But navigating through retirement, we're talking about so many different nuances and complexities of retirement planning. Unless you're seeing it, you're breathing it, you're living it every single day, there's no way that you're going to account for everything. And that's kind of what I'm hearing.
Yeah. No, exactly. And there's just, and it could seem overwhelming, but I would encourage everybody here to find somebody, work with the fiduciary advisor, someone that you trust, love, and respect. And again, to your point, Jordan, is that, I think in a perfect world, we all live happily and we travel to our age 100 and we die in our sleep holding our spouse's hands, glaring in each other's eyes, right? But that's not the reality. That's not what's going to happen. Phyllis was looking at me like, God, I hope not. That sounds terrible.
Not true.
No. But I mean, but you gotta be realistic about things as well. To your point, when you get here, there's this big pile of money that you have, and that's great. But how are you going to maximize what it is that you and your family get to keep, and to minimize all the other costs and expenses, whether it's taxation, fees, a bunch of different government rules and things like that, for yourself, to put yourself in the best possible position, given all the possibilities that are out there.
Yeah, I think to Jordan's point, we talk about this every week, Jordan, or whenever we do these. Point is, a lot of people don't know the differences, the different things that you have to focus on. And I don't think it's out there enough. I don't think enough advisors are telling that story. So if you're looking for an advisor, yes, they've got to be a fiduciary, but they also, a great question to ask them, tell me something. What's different about the planning that I've done up to this point and the planning I need to do now and throughout retirement? And if they can't give you a lot of different answers like that, go shop. Think about it, because they're still accumulation specialists. They've been great, but there's a big but. You work too hard not to get down the mountain safely and securely and on your own terms.
I love that.
Yeah. And if they're just talking about rates of return, and I would run.
Yeah.
I would run.
Yeah.
The 3 R's. You hear the rate of return, you run.
There you go.
Josh, this was awesome. Thank you so much for illuminating us on taxes, where we think things are going. This has been a ton of fun. Phyllis, I don't know if you feel this way, but Josh, you have been one of my very favorite guests that we've had so far. So thank you all so much. And till next time.
You've been listening to the RPU podcast with Jordan Schwartz and Phyllis Polvinas.